Are you constantly buying at the top only to watch prices crash? Or selling at the bottom just before a massive rally? If you keep losing money in the market, it's because you're missing one crucial signal the pros use to spot reversals. Today, we unlock the power of the Relative Strength Index, or RSI, a momentum oscillator designed to reveal market turning points. Developed by J. Wells Wilder Jr. in 1978, the RSI measures the speed and change of price movements. Think of it as a speedometer for market momentum, oscillating between 0 and 100. The most common application is identifying overbought and oversold conditions. Traditionally, an RSI reading above 70 suggests an asset is overbought, meaning buying pressure might be exhausted. Conversely, an RSI below 30 indicates an oversold condition, implying selling pressure could be running out. These levels act as warnings, signaling potential price retracements or reversals. However, here's the critical nuance: overbought doesn't automatically mean sell now, nor oversold by now. In strong trends, the RSI can remain in overbought or oversold territory for extended periods. This is why context matters. Always consider the overall market trend and price action. The standard RSI period is 14, whether it's 14 days, 14 hours, or 14 minutes, depending on your chart timeframe. While 70 and 30 are traditional, some traders adjust these levels to 80-20 in highly volatile markets. But the most powerful RSI signal, often missed by beginners, is divergence. Divergence occurs when price and the RSI indicator move in opposite directions. A bullish divergence forms when price makes lower lows, but the RSI makes higher lows. This suggests that despite falling prices, selling momentum is weakening, hinting at a potential upward reversal. Conversely, a bearish divergence happens when price makes higher highs, but the RSI makes lower highs. This indicates that buying momentum is fading, even as prices push higher, often preceding a downward reversal. Divergences are considered stronger signals because they show a shift in the underlying strength of the move. Always look for divergence near key support or resistance levels for higher probability setups. Another way RSI helps is by identifying the general trend. Readings above 50 often signal a bullish trend, while readings below 50 typically indicate a bearish trend. The 50 level acts as a centerline; crossing it can indicate a shift in market sentiment. However, the RSI is a lagging indicator, meaning it reacts to past price movements, not predicts the future. It's crucial not to use RSI in isolation. Combine it with other tools like price action, volume, or chart patterns. For example, an oversold RSI combined with a bullish engulfing candlestick pattern near support is a stronger signal. Always practice disciplined risk management. No indicator is 100% accurate. False signals are common, especially in choppy or highly volatile markets. Understanding RSI's strengths and limitations empowers you to make more informed trading decisions. It's a powerful tool, but like any tool, its effectiveness depends on the skill of the user. Master the RSI, and you'll begin to see market moves that others simply can't.